we know these factors are out there. We know the monetary measurement of silver says you could go ridiculous on the upside, or at least seemingly ridiculous, go to $500. Our assumption is that it will occur very quickly, meaning within a couple quarters probably. Well, our clock began when? After the close of November. That's when the spread broke out. So these Jan, Feb, March, April, May, okay, maybe another month or so, I don't know. But, there's a couple quarters, let's call it, maybe 3. But dramatically, and not go from here to, let's say, 3 to 500 over 3 years. It will have a tantrum. It's already showing some signs of a tantrum here. You can look at the chart.
A one-day crash that goes nowhere afterward isn't failure, it's compression. When price gets violent but direction disappears, the market is usually storing energy, not losing it. Michael Oliver breaks it down clearly. The late January drop was highly concentrated, with roughly 90% of the move hitting on January 31st and minor follow-through into early February. Since then, gold and silver haven't trended, they've chopped sideways. Silver has been swinging in a wider range, gold in a tighter one, but the result is the same, erratic, back-and-forth price action that's been punishing both longs and shorts on the daily timeframe. The timing caught many off guard. The expectation was for that kind of break closer to April, not January. But in Michael Oliver's framework, the shift in timing doesn't damage the bigger picture. The primary uptrend, especially in silver, was already confirmed back in November, when a key long-term signal triggered the current phase higher. What matters more is the relationship between silver and gold. Michael Oliver points out that when silver starts outperforming gold in a sustained way, it typically signals the midpoint of a much larger bull move, not the end of it. That pattern has repeated across past cycles, where a breakout in the silver-to-gold ratio led to sharp, accelerated gains in both metals, with silver taking the lead. That same dynamic is unfolding now. Silver's surge from the mid-$50 to above $120 in just a few months reflects that shift. The pullback into the $60 and now stabilization around the $70 doesn't negate the move. It reinforces the idea that this is consolidation within a continuing uptrend, not a reversal. If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying attention. We're here to keep bringing you sharp analysis and voices that understand what's unfolding. Thanks for watching.
Yes, I still assess that. I think that the break we had mostly in one day, January 30th, 1st, last day of the month of January. Most of the break occurred then, 90% of it, okay, one day. And since then, if you stand back and look like at a monthly chart of gold or silver, it's really violent sideways. In a wide range for silver, a less wide range for gold, but it's just really been net sideways.
Daily chart of gold. Okay.
Daily,
so
yeah.
This is the day you're talking about here, the peak
right
there.
Yeah, that big day. And then there was some follow through on the first day of February. But basically, most of the break occurred in 2 days.
Yeah.
Back to the 2 big red candles here. And then since then, you can draw a line sideways and you're short, you're winning. Oh, suddenly I'm not winning. You're long. Oh, got stopped out. First off, we argue that the market drop in January was likely to occur. We thought it might occur later, like in April or so, based on our timing assumptions about this major surge in the monetary metals. We define it as having commenced really big time in November of last year. For silver, that was our final long-term buy signal. If you got a silver chart somewhere.
Boom. There we go.
Go to a weekly would be best if you could do that.
Okay. Weekly done.
Yeah. Okay. In the last several years, we put out 3 major long-term based technical buy signals. One was back in 2024 after silver dropped down. Let's see, that would be 24 April of 24. Yeah, in 24 we were coming up. See the ceiling there at about $26.
Yeah.
So yeah. Well, when we came up there in March of that year, just to right of where you were then, we said we're going to break out. We didn't wait for the breakout, which means taking out 26 or 27.
Yeah.
We said, and we got up in the 25, 26 zone, said, okay, the market's going to start to accelerate now. Okay, that was at about 25 to $26 zone. Okay, mark
24,
that.
25, $26.
Then we had that first surge, got up to 30 something again, right in the middle of the 50-year range, of silver. And in the sharp drop in June of 2020, in April, May of 23, right there, that drop there. When we turned up out of that hole, we said you get back up into the 34, 35 zone, and it had already been over 35 twice in the prior year. But that in June of 2025, it was coming up through 34 again. And we said, okay, next major buy signal. Okay, that's our second one. The third one occurred in November of last year. November of last year, price was closed that month at $56. 56 and change. Yeah, that bar. That was not based on the momentum of silver. That was based on a spread relationship between silver and gold, meaning you plot an ounce of silver divided into an ounce of gold, express it as a percent. And at that point, when we plotted that chart, silver was breaking through a massive ceiling of prior spread relationships to gold. And it said, oh, I'm going to accelerate against gold. Well, in the past, when that has occurred, like in the mid 79 to 80 surge, or in the 2010, 2011 surge in silver, both of which peaked at 50, in the midpoint of those sharp advances, the spread broke out, meaning silver said, hey, I'm beating gold now. Okay, I'm no longer the dog. And
this is that point you're talking about right here is for 10
years
it was trading in this range.
And actually, we had another one at a lower level too, but that's okay. But at $56 was therefore our last buy signal.
Okay.
And this one was based on the spread relation between silver and gold. With the prior knowledge that in the past, whenever you have both markets going up, silver and gold, and silver's lagging, but there's a point at which during that trend, silver spread versus gold breaks out in a clear way.
Yeah.
At that point, usually both metals then accelerate, but silver far more than gold. Well, silver went from $56 to well over, 120 in a matter of a couple of months.
Yeah.
Yes, it pulled back into the 60s briefly, 2 times now. Now we're in the mid 70s.
The move most people would call extreme isn't where this ends, it's where it starts to make sense. Michael Oliver frames it as a shift into a completely new pricing reality that began back in November. From that point, the path towards silver reaching $300 to $500 isn't a wild projection, it's grounded in 2 simple frameworks. First, the monetary angle. If silver peaked near $50 in 1980 and you adjust that level for the expansion in money supply since then, the equivalent price today naturally lands in the hundreds. Not speculation, just currency debasement reflected in price. Second, the technical structure. On a long-term logarithmic chart, silver spent decades trading within a broad range, roughly a 10-fold move from bottom to top. When price breaks out of that kind of range, a standard projection is to replicate the magnitude of the range. That math alone points toward the $500 zone. It sounds aggressive, but structurally, it's consistent. Michael Oliver also points to a critical technical event, the recent downside break that quickly reversed. Gold briefly undercut its February low around $4,223, and silver dipped below its own key level, but both moves lasted only hours before snapping back. That kind of failed breakdown isn't weakness, it's a classic stop-clearing move. Late buyers got shaken out, liquidity was taken, and the market reclaimed its level almost immediately. In his view, that likely marked the end of the downside congestion. The range wasn't distribution, it was preparation. And with silver no longer lagging gold, the next phase isn't just higher prices, it's faster, more aggressive upside, with silver leading the move. Let's get back to the interview.
And so we defined months ago, back in November, that we're going into a new reality. And it's highly likely silver could go to such levels as 300 to 500. How do we come up with that? Well, you can do it on a simple monetary basis. I think Eric Sprott, for example, has used this in lectures, that, if you take the money supply where it was in 1980 and how much it's increased. And silver merely reflected, silver was $50 in 1980, okay? And silver price now reflects the increase in the money supply. Well, you'd be hundreds of dollars, okay? There's another way to do it. If you look at a silver chart on a log scale, you've got an arithmetic scale there. But put a ratio scale, going back to the 1970s. Yeah, there's your two peaks.
Okay, right here and here.
And the bottom of the range is down around $4. Okay.
Yeah.
Yeah, there. Okay, so you got a range that's what's the difference between the highs and the lows? About a tenfold.
Yeah.
Plus, okay. You break out of that range and do a swing objective of it, a simple price chart technique. And it says, gee, I go to $500.
Okay.
A tenfold, break out of the range, go tenfold. Okay. Don't be shocked by it. And we also know that in the last 4 or 5 years, fundamentally, and this is something we don't keep up with because, frankly, the fundamentals are often lagged in creating the reality. But silver supply demand has been in deficit. The new silver versus the demand. This has been in consistent deficit for like 5 years now. They can't produce enough silver. And we have strong industrial demand. Used to be it was for photographs. Remember that? I don't know if you remember that far back or not. And then now it's solar development around the world. In the photovoltaic cells is silver. And it's also in the AI generation stuff, the big plants are being built and so forth. There's a lot of silver in that. Anyway, that's not our issue. But we know these factors are out there. We know the monetary measurement of silver says you could go ridiculous on the upside, or at least seemingly ridiculous, go to $500. Our assumption is that it will occur very quickly, meaning within a couple quarters probably. Well, our clock began when? After the close of November. That's when the spread broke out. So these Jan, Feb, March, April, May, okay? Maybe another month or so, I don't know. But, there's a couple quarters, let's call it. Maybe 3. But dramatically. And not go from here to, let's say, 3 to 500 over 3 years. It will have a tantrum. It's already showing some signs of a tantrum here. You can look at the chart.
Yeah.
Anyway, so that's the reality we see. And we're only, on the clock, maybe halfway through that process. And quite often what happens in the latter part of that couple quarter explosion is where most of the price increase occurs. And there's underlying monetary factors as well. People forget that silver is not just an industrial metal. It behaves like gold. Whereas a lot of people like to think of silver as an industrial metal, therefore, it goes up and down in recessions. Well, first off, that's not true. And secondly, commodities can go up during recessions, as the late 70s proved to us, and other times as well. You have a global recession and commodities explode, okay? The key factor underlying silver, I think, is monetary. The industrial is a side event. Important, but not the primary. And when gold goes up, silver goes up. The issue is which one goes up more and faster. And silver has been lagging, and now it is not. And I don't think it will lag in the next several quarters as well. You'll see more drama there than you will in gold on the upside. I think the congestion zone is done on the downside. In other words, we had this violent range. And about a month ago, or 3 weeks ago, we put out a report and we suggested that, hey, the February low on gold was 42.23. We said, it's too obvious. Let's go take it out and run some more stops. In other words, anybody who bought late on silver or gold, didn't buy it at 30 or 25 or 30 or 50, or they bought silver at 110, let's say, and bought gold at 5,200. They got bagged, okay? But there was that low in February that we held above all during March. And finally, we started to approach it again with the war event. We said, take it out, run the stops. And if you look at the hourly action the day we ran those stops, it spent like 2 hours or so below the February low and then right back up again. Both silver.
You're talking about this bar right here, right?
Yeah, that bar right there. See, one day took out the Feb low.
Yeah,
and
yeah.
immediately said, "Oh, I've had enough."
Here's
Okay,
the hourly chart. So
yeah,
yeah,
it literally was a
90
couple
minutes or
hours.
something, and then we're back up
Yeah,
to
that low was 42.23, so the prior to the Feb low. So it
yeah.
literally was a couple hours below it. And then you immediately said, I'm back above it. Same with silver. Its low had been like 66, went down to like 61 something.
What appears chaotic in the short term is more likely a transition within a much larger structural shift. The sharp, isolated breakdown followed by extended sideways volatility and failed downside moves suggests the market has been absorbing pressure rather than weakening. At the same time, silver's breakout against gold, combined with long-term monetary expansion and ongoing supply deficits, supports the case for a continued uptrend. If past patterns repeat, this consolidation phase may resolve into a rapid, high-impact advance, with the majority of gains occurring quickly and silver leading the move more aggressively than gold. If this consolidation is truly a midpoint rather than a top, what specific signals would confirm that the next explosive phase in gold and silver has actually begun, and how can you distinguish that from another false breakout? So, stay tuned for clear, data-driven insights into the financial system. Don't forget to like and subscribe so you never miss our weekly updates. Thank you for your continued support, and we hope you enjoy the video.